It's interesting because a lot of folks confuse multiples of profit or EBITDA with valuation. And those two things are not the same. It is a way to benchmark your approximate value or range of values is to do a multiple of EBITDA based on your specific area of specialty in the world of IT services, but it is not the same thing. Hello, and welcome to this week's Shoot the Moon podcast, broadcasting live and direct from Revenue Rocket World Headquarters in Bloomington, Minnesota. If you are a follower of Revenue Rocket is the world premier M&A expert in the world of IT services. With me today are my partners, Ryan Burnett, Matt Lockhart. Welcome, guys.
Great to be with you, Mike. I know we got a great subject here today, Ryan, but first, a little weather update from the Great White North. We are going to have a white Christmas this year. For those of you who like that Norman Rockwell kind of painting, we got it for you. Ryan, more important things. What are we talking about today?
Hey, Matt and Mike, appreciate you being on the call here today. As Mike mentioned, we are leaders in mergers and acquisitions for IT services firms. And one of the things we do is help CEOs and founders really navigate the world of selling their company. Today, we're in the third part of a series, a Masterclass series on what it means to sell your company, your IT services firm. And we previously talked about readiness and getting ready and also the decision to sell. But the next thing, once you're ready to go, it's understanding how valuations work in the space and really what's your firm worth today and what will the market bear with that. So Mike, Matt, I really wanted to ask you a few questions on what it means to understand valuations today. And when we're talking M&A in IT services, Mike, I'll start you out. What are buyers really valuing when they're looking at acquiring an IT services firm? And what should sellers expect to understand when they're taking a firm to market?
Yeah, thanks, Ryan. Great question. Valuation, it's interesting because a lot of folks confuse multiples of profit or EBITDA with valuation. And those two things are not the same. It is a way to benchmark your approximate value or range of values is to do a multiple of EBITDA based on your specific area of specialty in the world of IT services, but it is not the same thing. And, buyers price future performance, not just kind of past stories and financials that are put on the board. They're trying to have a certainty of future cash flows to get a return on investment. And they have to understand that the history of the business, how, we'll get into this in a lot more detail, but a lot more to do with what is the certainty of those future cash flows? What is their comfort in those future cash flows? And you should know that every kind of services, IT services business by flavor is priced a little differently. Like, in general, IT services companies are not SaaS companies. Obviously, there's, risk and predictability drive every number in the valuation. And so understanding where your specific type of IT services companies falls from a general guidance valuation range is important to give you context. And then these other attributes as it relates to, getting comfort around certainty of future cash flows certainly will help drive a valuation number that, is where the market will ultimately trade a deal if you're going to market.
So if I hear that right, Mike, companies in the space, you're typically acquiring a going concern in which the business is operating, and you're going to value that based on the contribution of its ongoing cash flow. That's why it's important to understand if you are using multiples as a figure in this, understanding that a valuation is not an offer, and even a valuation is much more than a multiple. But if there is a multiple applied to it, it's going to be done off the earnings or the adjusted EBITDA of the company compared to any other metric that might be considered. Fair, Mike?
That's fair, right?
It really helps set the stage. valuations is a big range, and something understanding the risk and predictability of those earnings is critical in our case. So Matt, if I start to think about drivers of revenue, and I really would love to get your pick on how does revenue quality, things like recurring revenue or contracts and churn or even customer concentration, how does that start to influence the valuation and the valuation multiples?
Yeah, Ryan. I mean, I think so. We've sort of set a baseline, right, through, EBITDA and predictability. And so you've sort of got a baseline range. And now we'll sort of start to dive into how do you get a premium or where might your valuation be discounted? And revenue is obviously one of those first key things. And so, as you're thinking about your business and you're thinking about your business moving forward, and again, in that lens of predictability, how can you demonstrate that through your past and current and then forecasted revenue moving forward? So you brought up recurring revenue, which is obviously a highlight for an IT services firms, where they are signing, if not yearly, multi-year contracts that have well understood renewal periods. And, that's a real good guy. That is an opportunity to see a premium on that baseline valuation. And think about it. Predictability is key. You've got customers that are signed up for a longer term period of time. Most often the renewal rates are very high for those services that, fall under that recurring revenue umbrella. So the higher that you can demonstrate a recurring revenue percentage against your overall revenue, the better. The more that you can demonstrate that revenue, that recurring revenue growing, the better. And so that's a key one that we certainly see. Now, some services, many IT services firms contract on a project base, which is great. You can do large projects, do meaningful work for your customers in that format, and it's not recurring revenue. But if you can demonstrate the reoccurring nature, the year-over-year sign up by same store customers, same store clients that are building upon that project-based revenue, that is also a good guy. Versus you do one project, then you never see that customer again. That's not as good. People might see that as an opportunity for a discount. Again, simply because there's less predictability in that fashion, which then, goes to, what you pointed out, churn, right? And the more churn there is within your client base, the more that you're having to go get new revenue from new customers because there's a certain amount of churn. Well, that's an opportunity for a discount, right? And it can be that way simply because of the way that you've built your service line. And it could be that way because of poor customer service and poor client relationships. But in either of those, that is seen as certainly a negative. And then the last piece related to revenue is just how concentrated is your revenue. How much of your revenue is within one customer or a small subset of customers? And clearly the risk there is that you lose those customers, right? And that revenue goes away. And so if you've got, in an extreme fashion, 60, 70% of your revenue with one or two customers, that's going to be applicable for a discount as well. So revenue is absolutely critical. Thinking about your revenue, not just not like right prior to going to market, but thinking about that over an extended period as you're building your strategy and building your go-to-market is absolutely critical towards getting that premium valuation.
Yeah, thanks, Matt. I think you really covered that well. Everything from recurring to contracted revenue, churn, concentration, those are all huge metrics. And on the revenue generation side, and Mike, when you think about this, we mentioned earlier, if revenue is very strong, profit starts to become one of the big things that firms look at. So why is adjusted EBITDA and the margin profile, why is that so central to valuation for these tech services firms?
Well, Ryan, that's really back to, what I mentioned earlier, the predictability of the cash flow drives the model, right? And a strong growth trajectory on profit year over year, as well as, industry leading profitability vis-a-vis their peers, your peers as a company, are strong indicators that, you're a disciplined operator, right? You're someone who can scale and reinvest for growth. And, you've probably heard, the term add back to EBITDA. And just for clarity's sake, EBITDA is earnings before interest, taxes, depreciation, and amortization. And those add backs have to do with things you may be spending money on that won't continue after someone acquires your firm. Most notably and often in the books of a small business that's closely held are things like a car lease, for example, or maybe there's some things that for owner benefit, we'll call them owner benefits, maybe sports tickets for, maybe you have a box at a ballpark or something. Those things are typically not going to be continued post-transaction and can be added back. But those have to be very clean add backs. You can't have, run profit to zero because you spend all your profits on benefits for the owners and then expect to add all that stuff back. That's disingenuous in the sense that it's not how a buyer would see someone who is running a business from a disciplined perspective is running it. Likewise, if you make mistakes in your management of the business, aka we see this from time to time where someone says, well, I hired a couple sales guys, they didn't really work out. We did this, we did that. We invested in a marketing program, didn't really work out. We want to add that back to EBITDA. That's a tough one, right? Because these are investments that you probably need to be making in the business, probably will continue to be making in the business. And just because there were quote unquote mistakes made in the history of those investments doesn't mean you get credit for those. That's just the systemic risk you would have in running the business. And so I think it's important to understand what is a reasonable and clean add back, what it will be accepted by a buyer, and what will be rejected. And a good M&A advisor can help guide you on that. Certainly it's where we provide, I think, some value with our clients. And I would encourage you to be talking to your M&A advisor, whether it's us or someone else, if you're thinking about running a process about, what would be a reasonable add back to put into EBITDA.
Yeah, I think a great discussion, Mike. This is a big topic. We've got a few podcasts that we'll point to here on this, but really having solid P&L that is understood, that has profit that's driven by a good margined business. So gross margins are strong, net margins are strong. I think are really, really important to think about. And if you think about the other contributor here in overall valuation, and Matt, just turning back to you again, one of the things that you had talked about earlier was just that revenue and revenue quality. Well, part of that revenue quality starts to become with your revenue growth rate. And oftentimes you also see specialization come into play, either a vertical market specialization or technology specialization. Can you help me understand a little bit how growth rate and specialization help change a firm's valuation range?
Yeah. I think that maybe peeling back one layer and thinking about combination of sort of the real value and maturity of your offering and your go-to-market really is kind of the driver around these things. So, the more that you can be seen as uh, helping your clients with their value, with their top line revenue, and or their profit, because of your specialization, the better. And because, on the sort of the lower scale, if you're seen as a commodity that can be replaced, well, oftentimes you are. If you are seen as a trusted advisor and as a partner that is critical to the ongoing function of your client, well, then you're much less likely to be replaced. And when that's the case, naturally growth occurs, and you see year over year growth within your customers, and you see new customer acquisition happening, and then you see year over year growth happen with those new customers. And what that demonstrates is, again, this sort of predictable line of revenue growth. And I think that sort of predictability as it pertains to growth is absolutely key. Sure, we've all experienced those home run years where you see spikes in revenue, and those are great. But if that then has an equal decrease in revenue in a subsequent year, well, that's not so good. And in comparison, when you see a relatively even straight line, up and to the north, boy, that's seen as a premium. And one of the things that you brought in, we talked about that specialization and being seen as a specialist. Oftentimes, we see that and advocate that can be done on a vertical basis, and meaning you are serving a certain segment of the marketplace, be that healthcare. It could even be a subsegment within healthcare. It could be financial services. It could be really any vertical market. But if you are seen as an expert in that vertical market, which then really allows you to be seen as a trusted advisor and closer to your customers and harder to replace, well, natural premiums occur in those circumstances. I mean, shoot, let's think about one of our recent wins for our clients who, was a specialist in the dental services marketplace. And they got an absolute premium because of their specialization and the process that we were able to run that demonstrated that specialization and being able to target those buyers that were already in that marketplace.
Yeah, great job on wrapping that up. I would say the other point here is if you do have that solid growth and that revenue, and it leads to healthy EBITDA margins, valuations do increase based on the relative absolute size of your firm. So think about big targets of again, revenue driving to EBITDA, but 1 million in EBITDA is going to be a lot different than when you're at 3 and 4 million in EBITDA, which is going to be a lot different than 10 million in EBITDA. And those valuation multiples, the guideposts start to go up, just simply the larger the firm you have. Growth really leads to compounding effect when it comes to having execution in the market for getting the best offer that you can. Mike, if I switch gears a little bit and you think about, what we just talked about was that revenue quality and the profitability quality and that growth and customer base. What are some mistakes that founders have made that can suppress valuation? And how can someone avoid some of those mistakes that are out there?
Well, Ryan, I tell you, there's a variety of them. One of which I'd like to point out is just messy bookkeeping, right? If someone can't make good sense of your books, they can't forecast sort of the value of the future cash flows, and they can't get to a meaningful number. And if there's questions or doubts about how you've done bookkeeping historically, it starts to add fear, uncertainty, and doubt in the minds of an investor or an acquirer, where they may just walk away. We've seen people do that, right? Walk away from a set of books, or we recommend our clients that we represent, they're looking to acquire, just say, look, we can't make sense of these books, so it might be best to either offer a materially discounted offer or just walk away. So making sure you have a good a good financial advisor, a solid and industry standard chart of accounts, and that you follow, good, solid accounting principles. I would say as close to GAAP. Most small businesses are what I like to call GAAP-ish. They follow generally accepted accounting principles pretty closely, some of which don't 100% make sense for small businesses. So, they need to be well managed. I think also having a messy contracts, like all of your some are contracted, some are not contracted, some are aged out, some don't have transferability clauses in them, some do. Consistency in how you contract with your clients and keeping good records from that perspective will go a long ways towards, maximizing your valuation, as will, reducing and eliminating as much as possible founder dependency, especially if you're considering moving on or selling out over a period of time. Founder dependency, particularly for financial buyers, is a big problem. They want to look at ways that they can scale and either have the founder move into a bigger role within the firm as they introduce capital. A private equity firm may want the founder to drive M&A or to drive strategy and be less involved with the day-to-day operation. Or ultimately, they may want them to, maybe they're saying, hey, I want to retire. So you can't sort of turn over a business that's entirely based on your involvement and expect that you're going to get a premium valuation. You have to make investments in a team that will allow you to scale and grow the business without you. I often say work yourself out of a job while you own the firm. That's important. I think inconsistency in reporting and, maybe even not being ready for a quality of earnings analysis or having done a quality of earnings analysis. Some firms prepare a quality of earnings analysis ahead of time in order to speed the acquisition process, and we think generally that's not a bad idea. If you have any concerns or questions about the validity of anything you might have in the accounting record. And I think, obviously early preparation on all these topics will protect and fortify your value moving forward.
I think it's great if you look at those valuation killers. And last question I've got for you, Matt, here before wrapping it up. If you think about that opposite, and I think Mike, you did a nice job of alluding to some of these, but if a founder wants to meaningfully increase the valuation, let's say over the next year or two, what are one or two focus areas that really should take a look at to do that?
Yeah, well, I think that Mike sort of started it out, and I love this topic, which is really preparing ahead and readiness to maximize value is a multi-year opportunity and kind of project. And so it's really addressing kind of all of the things that we talked about. So let's start with market positioning. How well are your services and the offerings addressing what is most needed in the market? So an example today, if you are not able to answer in some way how you are building strong artificial intelligence capability within your firm, well, then quite honestly, you're behind. And so, but that doesn't mean that you can't catch up and leapfrog. But that's one of those things that can be done in a longer tail, readiness opportunity. Clearly, the quality of your revenue and being able to demonstrate that and then have the data support it on a readied basis and shooting for those revenue related premiums, be it recurring or reoccurring, and demonstrating the growth in that. And then it's really down to what I'd call sort of the foundational aspects in building that strong foundation, which is your leadership team, your operating model, right? And the consistency of that operating model, and which all, really sort of gives buyers that confidence that not only from a historic perspective, but from a go-forward perspective, there is an opportunity for consistent growth and consistent earning, right? And so, all of those things can be done. Done it myself. Mike has, Ryan has. We've all lived through these longer tail readiness opportunities that have, really resulted in getting onto that premium side of the valuation scale.
Great topic here, guys. Mike, I'll leave it to you to wrap up. Again, very compelling, and we'll see it on the next episode on this masterclass.
Thanks, Ryan. Closing insights, I would just make an argument that you're going to hear a lot of gossip in the market about what multiples are and what are being paid by certain buyers in the market, or more importantly, what someone may have gotten in an exit. Just take all that with a grain of salt. My experience has been that the numbers you hear on the golf course or, around a peer group or at a conference are seldom accurate. There's a lot of things that go into those numbers that someone's not going to share with you. And whether they're even close to market I've heard just such wild numbers at conferences, I could write a book about it, that we know are just not factual. And so just take all that with a grain of salt, get a good advisor, get evaluation done on your business, begin planning this years in advance, not weeks or months in advance, and, go take the hill. With that, we'll tie a ribbon on it for this week's Shoot the Moon podcast. We encourage you to tune in next time for the next step in our masterclass. And thanks for listening, and make it a great week.